Welcome back, architects. You have mastered the deceleration strategy and secured your financial future. The final, highest form of wealth is not what you possess, but what you transfer. This is the legacy of experience ensuring the knowledge, systems, and mindset that created your fortune live on. This episode is about graduating from managing your money to managing your wisdom. Pillar 1. The intellectual property trust. Your most valuable asset isn't your stock portfolio. It's your system, the proprietary knowledge, investment rules, and business principles you developed from the blueprint to the value doctrine. The fix, document, and codify create a formal, detailed document, a family investment constitution or architect's playbook that outlines the core rules. Your personal version of the 50/30ths 20 rule, the asymmetric test, and the discipline paradox episode, the allocation strategy. Your current capital allocation matrix episode 19, and the logic behind the deceleration strategy episode 27, the why. The story of your inciting incident, episode 1, and your ultimate purpose metric episode 14. This document transfers wisdom, not just cash. It protects your heirs from making emotional, system-destroying mistakes. Pillar 2. The next generation architect. Passing on wealth without passing on the wisdom that created it is the fastest way to lose the fortune. Studies show that a majority of fortunes are dissipated by the third generation. The fix, active apprenticeship. Wealth transfer should be a gradual, active apprenticeship, not a sudden inheritance. Controlled exposure. Involve the next generation in your quarterly allocation. Review episode 19, meetings with your personal board, episode 22. Let them observe the decision-making process, especially the difficult choices involving risk and opportunity. The value creation mandate. Structure wealth distribution via trusts. Episode 7, so that a portion is accessible only after the heir demonstrates competence in value creation. Successful completion of a business project, achieving a high-level educational goal, or demonstrating charitable impact. The example, the Rockefeller family established trusts and family offices not just to manage money, but to actively manage the family's values and teach financial literacy to every generation. Pillar 3, the philanthropic multiplier. Your legacy metric is the ultimate expression of your values. It should be structured for maximum long-term impact, leveraging your financial expertise. The fix! Endowments and strategic giving. Instead of sporadic charitable donations, establish a small family foundation or a donor-advised fund. DAF leverage. Use the DAF to manage your charitable funds. You receive the immediate tax deduction, and the capital continues to grow tax-free like a supercharged investment engine until you decide to disperse it. This multiplies your giving power over decades. Your action step for this final mastery episode is to schedule the first block of time at least 5 hours to begin drafting the Architect-S Playbook or Family Investment Constitution, focusing on the rules that guarantee long-term stability. We have reached the end of the formal training. You have built the fortress, conquered the inner game, mastered isometric risk, and established your legacy protocol. The journey from scarcity to abundance is complete, but the work is perpetual. This final episode is the synthesis revisiting the core lessons and defining the ultimate purpose of this vast undertaking. The 3 non-negotiable laws. If you forget everything else from this series, these 3 laws must govern your financial life forever. The law of compulsory investment discipline. Pay yourself first. Automate your 20% investment fuel, episode 2, and your R&D. Lockbox, episode 14. This rule safeguards your future from your present self. Consistency is the single greatest competitive advantage. The law of asymmetric action strategy. Only allocate your time and capital to opportunities where the limited downside is dwarfed by the unlimited upside, episode des essais. Eliminate proportional risk. Focus on the high-impact 20%. Episode Navi. The law of perpetual learning defense. Your financial firewall protects your capital, but the 5-hour rule protects your relevance. Episode 8. The moment you stop learning, your 1% upgrade skill begins to decay. Your intellect is the ultimate hedge against every market threat. Episode Vinci Innovi. The final synthesis. Freedom is a tool. The ultimate realization for the architect is that financial freedom is a means, not an end. It is a tool designed to maximize your legacy metric, episode 14, and your unique human contribution. If you achieve your North Star but fail to maximize your freedom of time and freedom of thought, episode 25, you have failed the ultimate test. Use your secured capital to invest in 3 non-financial assets. Impact. Fund the charitable causes that align with your deepest values, episode 28. Use your wealth to address the problems you care most about. Health. Fund the optimal physical and mental routines necessary for you to execute at peak performance for decades to come, episode 9. Health is the prerequisite for all other forms of wealth. Truth. By the time and space necessary to pursue deep, unfiltered truth, whether through mentorship, research, or contemplation. Your greatest asset to the world is your unique perspective. The architect's final commitment. The difference between a story with a great ending and a great life is one thing: the willingness to remain the student, even after becoming the master. Your final commitment is not to wealth, but to the system that creates it. Honor the system. Honor the process. And use the magnificent structure you have built to pursue a life of meaning, impact, and profound curiosity. You have achieved the pinnacle of financial architecture. The systems are running, the legacy is defined, and the fortress is secure. The final question is not how to keep the money, but how to keep the happiness that the money was supposed to unlock. This episode delves into the advanced philosophical and psychological protocols necessary to maintain profound fulfillment in the absence of financial struggle. The hedonic treadmill. The hedonic treadmill is the psychological phenomenon where every new purchase, every new luxury only provides a temporary spike in happiness before returning to baseline. If you chase happiness through consumption, you are doomed to run forever. The fix. The friction audit. Use your wealth not to acquire more things, but to strategically remove friction from your daily life, thus increasing baseline happiness. Remove frustration. Invest capital in solving the small, persistent annoyances that drain your emotional energy. For example, traffic, frustration, household maintenance, chaos. Buy flow states. Use your freedom of time, episode 25, to maximize activities that induce a flow state, deep concentration, and enjoyment. For example, focused work on your legacy metric, advanced hobby mastery. Flow is the opposite of the hedonic treadmill. The social isolation risk. Extreme financial success can lead to social isolation. You may feel unable to relate to former peers or suspicious of new relationships. This is a severe threat to long-term well-being. The fix? The shared experience mandate. Use your experience portfolio, episode 25, to build genuine connections, not merely to flaunt wealth. Shared struggle. Invest in challenging, shared experiences, for example, multi-day expeditions. Joint philanthropic ventures. Focused mastermind retreats. Shared difficulty forges deeper bonds than shared luxury. Mentorship as connection. View your mentorship commitments, episode 1528, as a primary source of connection and meaning. By helping others build their own fortress, you reinforce your own sense of purpose. The final allocation. Investment in identity. The greatest asset you manage at this stage is your personal identity. You must transition from identifying as the hustler or the saver to identifying as the creator or the contributor. The fix. The daily contribution statement. At the end of your Zero Mistake Day, episode 17, review your actions and ask, did my actions today increase the value of my personal brand and my legacy independent of my net worth? Focusing on contributions separates your self-worth from your net worth. This final act of psychological resilience ensures that the man or woman you become is greater than the money you possess. The physical series ends here. But the philosophical work, the daily architecture of a meaningful life, is the one project that will never cease. You have the capital, the system, and the discipline. But in the final critical moments of a major deal, whether acquiring a business, episode Vinci says, securing a partnership, or selling a leveraged asset. Success hinges on the ability to negotiate. This final strategic episode is dedicated to mastering the language, psychology, and tactics that ensure you never leave value on the table. Principle 1. Negotiating with your feet. The ultimate leverage. The most powerful negotiating tool is the genuine willingness to walk away. If you need the deal, you have already lost. Your financial firewall and diversified portfolio, episode 19, are your secret negotiating weapons. The fix. The best alternative, BATNA. Before entering any negotiation, define your BATNA, best alternative to a negotiated agreement. Mandate. Your minimum acceptable outcome must be equal to or better than your BATNA. If the negotiation drops below your BATNA, you must have the discipline to stand up and walk away. Your financial system exists to afford you this freedom. Principle 2. The information asymmetry play in any negotiation. The party with the most information dictates the terms. Your 5-hour rule and continuous learning, episode 8, are key to winning before the conversation even starts. The fix. The 90-10 research rule. Dedicate 90% of your preparation time to gathering information about the counterparty, their needs, their constraints, their alternatives, and their internal politics, and only 10% on rehearsing your own demands. Anchor with confidence. Use the superior information to set the initial anchor. I number mentioned aggressively high if selling or aggressively low if buying. This anchors the entire conversation in your favor. Principle 3. Emotional distance and mirroring. Negotiation is a psychological game. Emotional investors are easy targets. The fix. The rational agent protocol. Detach. Never reveal that a deal is personal or crucial to your current plans. Treat every deal as merely one of many asymmetric opportunities. Episode Does It Say Smearing. Use empathetic curiosity. Listen to the counterparty's last 3 or 4 words and repeat them back as a question. For example, sounds like you feel the timeline is too tight, ... Too tight? This encourages them to elaborate, giving you more information and creating rapport while you remain emotionally neutral. The example of Chris Voss, the former FBI hostage negotiator, stresses that negotiation is less about manipulation and more about tactical, empathizing language to uncover the underlying psychological needs of the other party. Your action step is to define the BATNA for the next significant financial or business discussion you have, whether it's a salary, negotiation, a partnership, or a major purchase. Write it down and commit to walking away if the terms are not met. You have mastered every traditional and psychological aspect of wealth. But the financial landscape is being fundamentally reshaped by 3 forces: AI, blockchain, and automation. These are no longer just investment classes. They are essential operating layers for the advanced architect. This episode is about graduating from investing in technology to leveraging technology to manage your entire financial ecosystem. Layer 1, AI, as the chief analyst, the data edge, the human brain. Even yours struggles with the volume and velocity of global financial data. AI is your non-emotional, tireless analyst. The protocol. Automated signal detection. Instead of manually screening investment data or news, deploy AI tools for automated signal detection. Portfolio surveillance. Use tools to monitor your entire portfolio against your risk tolerance and asymmetric rules. Episode Desist. Get immediate alerts. If a core asset violates a preset metric, for example, moat degradation detected in X company due to new competitor patent. Tax optimization. Employ AI-driven tax software that constantly scans global regulations, episode 20, and legal precedents. Finding optimization opportunities your human accountant might miss. Your tax strategist, episode 22, then verifies the AI's findings. The principle. AI doesn't replace your judgment. It provides the superior non-emotional input necessary for your human judgment to be decisive. Layer 2. Blockchain as a security layer. Trustless transactions. Blockchain technology offers more than just crypto. It provides a framework for transparent, secure, and trustless financial operations. The fix. Strategic asset tokenization and custody. For your advanced to liquid assets, episode 21, and legacy protocol, episode 28, tokenization. Audit. Explore legally compliant methods for tokenizing fractional ownership of certain real assets like investment property or fine art. This could increase liquidity and simplify transfer, particularly for generational planning. Decentralized custody. Move Hivadi digital assets out of centralized exchanges and into secure, hardware-based self-custody solutions where only you control the private keys. This eliminates a single point of failure, a core theme of the Crisis Protocol, episode 24, Layer 3. Automation as the discipline enforcer. Automation is the simplest, most effective defense against the discipline paradox, episode Disasechi. It ensures the system runs perfectly even when your focus is elsewhere. The fix. The end-to-end autonomous system. Ensure every recurring financial action is automated and interconnected. Income to investment, from your leveraged asset revenue stream directly to your core compounding funds. The original rule, but now scaled. Distribution to bills, from your Income Fortress episode 27 directly to bill payments and expenses. Risk rebalancing. Set up automated triggers to sell small percentages of overallocated assets and move them into underallocated ones, ensuring your portfolio never drifts far from its target ratio. Your final action step is to identify the single most complex, high-friction financial process in your life today likely. Tax analysis or complex asset tracking again. Commit to researching one advanced AI or blockchain solution to streamline it this month. The future of wealth management is automated, decentralized, and intelligent. Master these layers to build the truly resilient, perpetual system. You have optimized your systems and mastered internal finance. However, advanced wealth is vulnerable to macroeconomic shifts, global forces like inflation spikes, sovereign debt crises, or massive geopolitical realignments. Episode Vinci. This episode is about building the ultimate global defense, using sophisticated portfolio structure to maintain real purchasing power across decades. Pillar 1. The inflation-proof core inflation is not uniform. It impacts different asset classes unequally. Your goal is to hold assets that either benefit from inflation or are contractually immune to it. The strategy: real assets and floating rate. Real assets, commodities, land. Maintain strategic exposure to commodities and raw materials, gold, energy, agriculture. These assets historically performed well when fiat currencies decline. Your Real Estate episode 4 provides a critical defense as rents and property values generally rise with inflation. Floating rate debt. Shift a portion of your portfolio bonds towards debt instruments where the interest rate adjusts periodically. Floating rate notes. This protects your income stream from being eroded by rising interest rates. Pillar 2, stress testing, the global portfolio, your crisis protocol, episode 24, must now include international economic scenarios. The fix. Scenario modeling, annually. Instruct your fiduciary wealth manager, episode 22, to model the impact of 3 extreme scenarios on your total net worth. High interest rate shock. What happens if global central bank rates reach 7%? Impact on bond portfolio and business financing costs. Major currency devaluation. What happens if the currency you primarily use devalues by 20%? Impact on your currency hedge and import costs. Regional conflict. What happens if geopolitical instability affects a key supply chain or export market for your leveraged asset? The purpose of this test is to identify weaknesses in your agility episode 20 and adjust the capital allocation matrix episode 19 before the event occurs. Pillar 3. The talent exodus hedge, the next economic engine. Economic shifts are driven by the movement of capital and, more importantly, talent. The next great economic engine will emerge, where regulation is lightest and human capital is concentrated. The fix. Frontier investment scouting. Allocate a portion of your Moonshot Fund episode 10 to actively scout and invest in nascent entrepreneurial ecosystems. Outside of major hubs, for example, specific cities in Southeast Asia, Latin America, or Eastern Europe. The asymmetric advantage. Early investment in these regions is risky, but the valuation is low, and the potential returns, the unlimited upside, are massive if a region transitions to a high-growth hub. This aligns with the core principle of asymmetric thinking, episode Desi 6. The example of successful globalists, investors like George Soros and Michael Steinhardt, gained their edge by viewing capital as fluid, constantly moving it to benefit from or hedge against anticipated sovereign and macroeconomic policy changes. Your action step is to identify the single biggest macroeconomic risk to your primary wealth base. For example, inflation, taxation, or geopolitical instability, and dedicate your next 5-hour rule session to finding a specific non-correlated asset to hedge against that risk. You have mastered the personal and systemic aspects of wealth. The final, most complex challenge is the dynasty protocol, ensuring the fortress remains intact, functional, and aligned with your values across 3 or more generations. This requires sophisticated legal, educational, and philanthropic structures. This episode is about graduating from mere estate planning to generational wealth planning. Pillar 1. The multi-jurisdictional trust structure, the defense. Simple wills and local trusts are insufficient for multi-million-dollar, globally diversified portfolio. You need a structure designed for tax efficiency and legal protection across borders. The fix: dynasty trusts and foreign trusts. Dynasty trusts. Established trusts that legally last for multiple generations, often utilizing the rule against perpetuities exceptions in specific states. This shields assets from estate taxes, creditors, and divorce, ensuring the capital remains within the system. Foreign trusts, the global hedge. 4 portfolios with significant international holdings. A strategically located foreign trust can provide enhanced asset protection and tax flexibility, hedging against severe domestic legal or political risks. Episode V. Consult your tax strategists and legal board members immediately. Pillar 2. The wealth education curriculum. As established in the Legacy Protocol, episode 28, transferring money without wisdom is destructive. The goal is to raise competent stewards, not passive recipients. The fix: the 3-tiered financial competency model. Level 1, ages 10 to 18, focus on basic financial literacy, budgeting, and the compounding concept. Use matching grants. The family matches their earned money to teach saving. Level 2, ages 18 to 25, focus on taxes, debt management, and the value doctrine. Episode Vinci says, the heir must manage a small, controlled investment portfolio and report its performance to the family council. Level 3, ages 25 plus, focus on asset allocation, philanthropic strategy, and risk management. The heir gains exposure to the personal board and may take a non-voting role in trust governance. Competency unlocks access. Pillar 3, the sustainable philanthropic vehicle. A large-scale philanthropic mission unites generations and prevents wealth from becoming a source of aimlessness or entitlement. The fix: the private foundation, or large DAF. Private foundation high control provides maximum control over grant-making, mission, and family involvement. It is a perfect vehicle for engaging the next generation in shared purpose-metric work. Venture philanthropy. Adopt an asymmetric approach, episode 16, to giving instead of merely funding charity. Invest capital into social enterprises or nonprofits that have a clear, scalable business model for systemic change. This aligns giving with your core skill set. The example of successful dynasties. Families that have sustained wealth for over a century, like the Rockefellers, credit their success. Not 2 smart stock picks, but 2 mandatory family meetings and educational structures that reinforce a shared set of values and the responsibility of stewardship. Your final action step is to schedule a meeting with your legal advisor to discuss the feasibility and structure of a dynasty trust for your long-term assets. Ensuring the system you've built operates flawlessly for those who follow you. You have optimized every financial variable across 35 episodes. But wealth management is ultimately an exercise in life management at the highest level. The greatest risks to your well-being and longevity are non-financial poor health, isolation, and a lack of purpose. These risks can destroy the freedom the financial system was designed to create. This episode is about applying the architect's rigorous audit framework to the human operating system. The health audit, the ultimate asset. Your body is the single most valuable asset in your entire portfolio. A catastrophic health event is the ultimate financial, time, and freedom destroyer. The fix: the bio-optimization budget. Allocate non-negotiable capital toward proactive health management. treating it as an essential defense against downside risk. Preventative diagnostics. Invest in advanced annual full spectrum preventative testing, genetic, metabolic, and cardiovascular screens. This is the asymmetric bet episode 16 for health. Small upfront cost to prevent massive future losses. Performance investment. Budget for personalized nutritionists, professional exercise, physiologists, and high-quality sleep technology. Your job requires peak cognitive performance. Episode Navi. Treat your biology as a high-performance machine. The relationship firewall, the isolation risk. As wealth increases, genuine, unbiased relationships become rare and valuable. Social isolation is a key predictor of physical and mental decline. The fix. The focused circle investment. Just as you audit your investments episode, there's a Navi audit your key relationships. Active pruning. Ruthlessly prune relationships that are purely transactional, energy draining, or only focused on your money. The low profile protocol from episode 17 helps here. High volume allocation. Dedicate time and resources from your experience portfolio. Episode 25 to actively deepen relationships in your focused circle family, mentors, and genuine peers. Shared. Challenging experiences. Build trust and loyalty. The true soft leverage. Episode Kingsey. The meaning audit. The purpose gap. Achieving financial freedom often leaves a purpose gap. The feeling of emptiness once the chase is over. A lack of purpose accelerates mental decline and can lead to The fix. The legacy time mandate. Treat time spent on your legacy metric. Episode Couture. And philanthropic goals. Episode 35 as a compulsory allocation, just like your investment contributions. Active contribution. Do not simply write a check. Actively use your 1% upgrade skill and your expertise to solve problems in your chosen philanthropic domain. Your specialized knowledge is often more valuable than your money alone. Your action step is to schedule your most rigorous non-financial audit this quarter. Book the advanced health screening. Schedule the value weekend with your focused circle. And allocate 2 hours to actively advance your legacy metric projects. You have mastered systems, finance, and health. Episode 36. The ultimate non-renewable asset you manage is time. The difference between merely being rich and being a time billionaire is the final, ruthless optimization of your minutes. This episode is about graduating from managing time to owning it, ensuring every moment aligns with maximum value and fulfillment. Pillar 1. The principle of nonlinear time. Not all hours are equal. An hour spent on your 1% upgrade skill. Episode Trade. At your peak, energy is worth 10 hours spent on low-value email at 4 p.m. The fix. The value density. Audit. Rigorously track your time to identify your highest value density activities, those that produce the greatest return income, learning, or fulfillment per minute invested. Eliminate. Ruthlessly eliminate activities that have a low value density, even if they feel productive. For example, unnecessary meetings, excessive news consumption. Time chunking. Physically block out 3 to 4 hour chunks for deep work. Episode 9 on your highest leverage tasks. Do not allow these blocks to be fragmented by communication or low priority delegation. Pillar 2. The communication constraints. Communication is the greatest destroyer of Haval time. Constant notifications, immediate responses, and unfocused meetings fragment attention, eroding your focus. Episode Navi. The fix. Asynchronous communication default. Shift your default mode of operation to asynchronous communication, allowing for delayed, thoughtful responses, which maximizes your deep work time. Batching. Schedule fixed times, for example, 11 a.m. and 4 p.m. for checking and responding to non-urgent communication. Train your personal board and team. Episode 22 to respect these boundaries. The medium filter. Use the communication medium that requires the least time for the required information transfer. A simple text, email for facts, a quick call for complex feedback, and a formal meeting only for collective Pillar 3. The time-based legacy. Your greatest legacy may not be the money you leave, but the time you dedicate to others and to non-monetary pursuits. The fix. The unscheduled space allocation. Consciously allocate time that is deliberately unscheduled. This time is not for work, errands, or even networking. It is for creative thought, family spontaneity, or pure rest. The discovery engine. This unscheduled time is often where the mind makes its greatest connections. Solving problems. Your conscious mind could leading to your next asymmetric idea episode 16 or greatest personal insight episode 31. Your final action step is to audit your calendar for the past week. Identify the top 2 activities that provided the lowest value density, wasted time, and commit to eliminating or delegating them immediately. You've mastered stability and time. Now, we confront the final challenge of the advanced architect: innovation risk. If you are too safe, you'll risk missing the next exponential growth wave. This episode is about deliberately structuring a portion of your wealth to capture the high, non-correlated returns of radical innovation. Pillar 1. The innovation allocation rule. Innovation is inherently risky, which is why your barbell strategy episode 16 is crucial. Your goal is to maximize the potential of your 10% moonshot fund while protecting your 90% safety net. The 5% rule. Within your existing moonshot fund, dedicate to a sublocation, for example, 5% of your total net worth, specifically to unproven technologies that could fundamentally change the global economy. This is your future fund. Known correlation mandate. These investments must be structurally non-correlated to the rest of your portfolio. When your public index funds are up, these early-stage ventures might be down, and vice versa. This is true diversification. Pillar 2. The 2 innovation channels. You capture innovation through 2 primary channels, both requiring high soft leverage. Episode 15. Direct venture investing the builder. This involves using your 1% upgrade skill to identify and invest directly in early-stage startups within your circle of competence. Episode 26. This requires more effort but eliminates intermediary fees and grants you greater control. This is the asymmetric bet on a specific team or technology. Leverage your value-add mentorship. Strategic advice is often more important than the capital itself, increasing your chance of securing equity at favorable terms. Specialized fund investing the scout. Invest in top-tier, highly specialized venture capital funds that focus on narrow, deep technological themes, for example, synthetic biology, quantum computing, next-gen AI infrastructure. This diversifies your high-risk exposure and grants access to opportunities otherwise unavailable. Caution! Ensure the fund manager's interests are aligned with yours and that they have a proven track record of capturing true asymmetry. Pillar 3. Managing the long-horizon innovation is a long game, often requiring 7 to 15 years for an exit. The volatility during this time can be extreme. The patience protocol. You must mentally write off the capital allocated to the innovation fund the moment you invest it. This eliminates the emotional urge to panic sell during the inevitable market volatility and aligns with the discipline paradox episode. Continuous review. Even with a long horizon, technology demands constant review. Use your rule to track the core technological breakthroughs and regulatory shifts that affect your chosen sectors. The active obsolescence test from episode 23. Your final action step is to define the exact dollar amount of your 5% innovation fund and identify one deep technological sector beyond general tech that you believe will fundamentally reshape the global economy in the next 2 decades. You have embraced innovation risk and secured your fortress against internal threats. The final layer of defense for the advanced architect is maintaining macroeconomic intelligence, the ability to interpret global, interconnected signals that preempt major market shifts. This episode is about graduating from reacting to news headlines to building a predictive framework for global finance. Pillar 1. The 3 macro watchtowers instead of monitoring thousands of data points. Focused on 3 key macro indicators that have historically correlated with major economic turns. The bond market, the smart money. The yield curve, the difference between short-term and long-term government bond yields is often a better predictor of recessions than the stock market. Action! Understand what an inverted yield curve signals. If the short-term rate is higher than the long-term rate, it signals market fear and potential economic contraction. This is a time to increase your cash bridge. Episode 24. The copper-gold ratio. The growth signal. Copper, often called Dr. Copper, is an industrial metal used everywhere, a proxy for economic growth. Gold is a hedge against fear and instability. Action. When the ratio of copper price to gold price is falling, it indicates declining confidence in future economic growth and rising fear. This suggests risk-off positioning and strengthening your inflation-proof core. Episode 34. The currency market capital flights. Global capital flows rapidly seek safety when risk increases. Action. Monitor major currency movements. Sudden, aggressive strengthening of traditional safe haven currencies like the US dollar, Swiss franc, or Japanese yen often signals a global deleveraging event or risk-off move preceding stock market volatility. Pillar 2. The second-order thinking filter. The amateur investor reacts to the first-order consequence. For example, the Federal Reserve raised rates. The architect anticipates the second and third-order consequences. Episode Vinci e Novi. Example, if the price of energy, oil, gas, rises. First order, higher pump prices. Second order, higher manufacturing costs and higher food prices, inflation. Third order, the architectural insight. Increased consumer stress leads to less discretionary spending, impacting high-growth consumer stocks and simultaneously increases the attractiveness of your inflation hedging real assets. Episode 34. The fix. Every time you hear a major economic headline, force yourself to identify the third-order consequence and adjust your allocation matrix accordingly. Pillar 3. The global portfolio immunization. Use your macro intelligence to immunize your core wealth from systemic shock. Rule. When global uncertainty is high. Your portfolio immunization requires you to increase assets that have a negative correlation with global equity stocks. Assets. This includes short-duration U.S. Treasury bonds. Hard assets, gold-specific, non-correlated digital assets. These are the lifeboats when the global ship takes on water. Your action step for this critical defense episode is to identify a simple, automated source, an economic dashboard or newsletter for tracking the 3 macro watchtowers and integrate it into your weekly Clarity Hour review. You have navigated the entire curriculum, from the blueprint to the global intelligence. You are no longer just an investor. You are a master architect of wealth, time, and intent. This final episode is the zenith synthesis of the highest level principles necessary for maintaining perpetual, purpose-driven freedom. The 3 laws of perpetual wealth. These 3 laws transcend market cycles and technological shifts. They define the mentality of enduring success. The law of asymmetric patience. The majority of your financial life must be boring. Stick to the core compounding episode 19 and the value doctrine episode 26 with extreme discipline to patience. Only act decisively when a genuinely asymmetric opportunity episode 16 arises within your circle of competence. Action. 99% patience, 1% aggression. The law of defensive learning. Never mistake current success for permanent knowledge. Your greatest defense against obsolescence, episode 23, and cognitive biases. Episode 29 is the rigorous pursuit of new knowledge through the 5-hour rule. Episode 8. The moment you stop learning, your wealth system begins to decay. The law of self-audit. Your greatest risk is internal, not external. Continually audit your health, relationships, and meaning. Episode 36. Use wealth to remove friction, purchase time, and maximize flow states. Episode 31. Your happiness and well-being are the ultimate. ROI, the final protocol. The unwritten chapter. The goal of this entire system was to create optionality, the freedom to choose what you do next. Now that your financial script is complete, your focus shifts entirely to the unwritten chapter of your life. The Time Billionaire Mandate, episode 37. Ruthlessly protect your time. Your final act of leverage is to dedicate your peak energy hours to your highest purpose, your family, your art, your contribution, or solving the problems related to your legacy metric, episode 14. The Integrity Filter, episode 25. Your reputation and integrity are the only assets that cannot be insured or repurchased. Guard them fiercely, as they are the foundation of your soft leverage and the true substance of your legacy. Final synthesis. Beyond the North Star. You started with a North Star, a freedom figure. You end with a Southern Cross, a multifaceted constellation of purpose that guides your entire life. The system is secure. The knowledge is transferred. Episode 28. The path is clear. You have constructed the ultimate financial machine. But life's final test is often internal. How you handle the volatility you cannot control. This episode introduces the Stoic protocol applying ancient philosophy to modern finance to achieve emotional invincibility. Pillar 1. The dichotomy of control. Stoicism teaches that we must divide the world into two categories. Things we control are thoughts, decisions, and efforts, and things we do. Uncontrol the market, interest rates, other people's actions. Financial anxiety arises from focusing on the latter. The fix. The daily control audit. Focus on process, not outcome. Your goal is not a specific market return. It's perfect execution of your system. The discipline paradox. Episode 17. Did you adhere to your allocation matrix? Did you execute your 5-hour rule? If yes, the day was a success, regardless of the stock price movement. Action. When stress hits, list 3 things causing anxiety. Circle the ones you can control. For example, I can control my reaction. Immediately discard the uncircled items. Pillar 2. Premeditation of adversity. Premeditatio malorum. The Stoics mentally rehearse the worst-case scenario. Not to be pessimistic, but to be prepared. If you have already considered a 30% portfolio crash, the real event is less shocking. The fix. The annual financial rehearsal. Scenario modeling annually. Review your crisis protocol, episode 24, and scenario modeling, episode 34. Reaffirm that your financial firewall and deceleration strategy are adequate to withstand a prolonged downturn. The emotional discount. Mentally accept the loss. Acknowledge the non-zero chance of total failure in your moonshot fund. This emotional discount eliminates the surprise factor that causes panic selling, episode 12. Pillar 3. The impermanence of wealth. Ultimately, all assets, wealth, and life itself are temporary. Attachment to the net worth number fuels anxiety. The fix. The intrinsic value focus. Shift your focus from extrinsic value, the market price, to intrinsic value, the real-world utility, meaning you derive asset utility. Reframe assets by their utility. Your house is a home, not a spreadsheet entry. Your business is a source of meaning and jobs, not just revenue. The final test. Remember that your legacy of experience, episode 28, and the quality of your relationships, episode 36, are the only things that cannot be taken away by a market correction. Your final action step is to define one piece of financial news that currently causes you stress. Apply the dichotomy of control to it, focusing solely on the next controllable action you can take within your system, ignoring the uncontrollable market outcome. You have mastered the Stoic protocol and secured your financial architecture. The final, most forward-looking investment strategy is to dedicate capital and time to human capital of the single greatest driver of asymmetrical wealth creation globally. This episode is about graduating from investing in assets to strategically investing in the people who create them. Pillar 1. The talent filter for investment in a world of information parity. The primary difference between a successful venture and a failure is the quality of the team. You must apply a ruthless talent filter to every high-risk investment. The fix. The founder, team, due diligence mandate. The VC mandate. For every illiquid assets or moonshots, episode 1021, prioritize the team over the idea. Is the founder highly competent, coachable, and persistent? The inner game attributes from episode 1. Track record over hype. Give preference to teams that have either succeeded or failed spectacularly before. Failure provides crucial experience and reduces the psychological risk of future failure. Pillar 2. Global skill arbitrage. Wealth is created when you leverage skills from where they are cheap to where they are expensive. Your leverage asset, episode 3, should be structured to exploit this global arbitrage. The fix. The remote value chain optimization. Outsource the commodity. Retain the strategy. Delegate low friction, high repetition tasks, for example, programming, Customer support. Data entry to talented individuals in lower-cost jurisdictions. This increases your profit margin and frees up your time for high-leverage strategic work. Retain the core IP strategy. Keep all strategic. High-level decision-making, branding, and core IP development within your immediate control. Your role is the architect conductor, episode 22. Not the laborer. Pillar 3. The mentorship multiplier. The two-way street investing in human capital is not just transactional. It is relational. Your commitment to mentorship, episode 28, is the highest return investment in your personal network. The fix. The reverse mentorship protocol. Traditional mentorship. Provide capital, connections, and wisdom to others. This strengthens your legacy metric and your soft leverage, episode Kinsey. Reverse mentorship. Actively seek out younger, high-performing individuals who are not paid advisors to teach you about emerging technologies, culture, and market trends. For example, AI blockchain from episode 33. This is your ultimate defense against obsolescence risk. The example? Companies like Google and successful hedge funds dedicate immense resources to attracting the top 0.1% of talent. Knowing that one genius can generate asymmetrical returns that outweigh hundreds of average performers, you must apply the same principle to your personal network and investments. Your final action step is to identify one high-performing individual who could teach you about a technology or industry outside your circle of competence, and schedule a value-first outreach session this week. You have mastered every level of financial architecture. This final, ultimate synthesis revisits the three greatest tools you've acquired: philosophy and people to ensure holistic, enduring well-being and wealth preservation across changing times. Pillar SATA systems. The non-negotiable audit. Tech and macro. The environment is in perpetual flux. Your system must be actively adaptive, not passively static. The protocol. The quarterly triumvirate check. Ensure your three great defensive systems are current. Tech resilience. Review your AI automation tools to ensure they are still the most efficient way to manage data and your output per hour OPH. Upgrade or replace outdated tech immediately. Macro resilience. Review your three macro watchtowers. Adjust your inflation-proof core based on current bond and currency signals. Don't react to headlines. React to fundamental data shifts. Legal resilience. A quick check with your tax strategist to confirm your dynasty trusts are compliant with the latest changes in international tax law. Pillar 2. Philosophy. The practice of contentment. The Stoic protocol must be a daily practice. True freedom is the absence of craving, not the abundance of possessions. The fix. The value, not cost mandate. Active gratitude. Daily acknowledge the intrinsic value of your life and assets, the health, the relationships, the freedom of time that money secured, not the market cost of your portfolio. The experience allocation. Ensure your spending prioritizes experience over consumption. Experiences are non-depreciating assets that compound in memory and connection. Pillar 3. People. The mentorship feedback loop. Your greatest value to the world is the knowledge transfer. And your greatest defense against stagnation is the feedback you receive from the next generation. The fix. The reverse audit and strategic giving. Reverse mentorship. Spend scheduled time receiving strategic input from high-performing younger talent. Let them test the assumption that your leveraged asset is immune to obsolescence. Strategic giving. Do not simply write checks. Engage with your philanthropic vehicle by demanding impact metrics. Apply your value doctrine and asymmetric thinking to charity, investing in solutions that can scale, not just those that offer temporary relief. This comprehensive, continuous cycle of auditing and adapting your systems philosophy. And people ensures the fortress remains relevant and the architect remains engaged. The process is the product. You have successfully navigated the entire curriculum. The final modern challenge to the advanced architect is information overload, the relentless tsunami of data, news, and noise that paralyzes decision-making and erodes cognitive performance. Your greatest moat must now be psychological. This episode is about building filters to protect your most valuable asset: clarity of thought. Pillar 1. The noise twos. Ignore filter. The vast majority of financial and political media is designed to elicit emotional response, not to convey actionable intelligence. This noise activates fear and greed. The protocol. The 3-source rule. Restrict your consumption of high-stakes, market-moving information to 3 non-emotional sources, for example, central bank reports, specialized industry white papers, or validated global economic data feeds. Eliminate. Cut out all cable news, non-specialized financial blogs, and social media commentary regarding market movements. This stops the herd instinct from influencing your rational decisions. Focus on policy, not personality. Concentrate on policy changes, interest rates, regulation, taxation, which are slow-moving and actionable, rather than the fast-moving opinions of market personalities. Pillar 2. The decision automation shield. Cognitive fatigue leads to poor decisions. The discipline paradox. The solution is to reduce the number of choices you have to make daily. The fix. The Cititan Forget It mandate. Automate every decision that is not high leverage and asymmetric. Automate your portfolio rebalancing so it happens on a fixed schedule, removing the decision from your plate. Saving, investing. Ensure your investment fuel is auto-debited and allocated instantly. Lifestyle. Automate low-value personal decisions. For example, meal preparation, wardrobe choices, travel routing to preserve your limited daily supply of mental willpower for high-stakes capital allocation. Pillar 3. The mental decompression protocol. Your mind, like your portfolio, needs periodic decompression to perform the essential work of synthesis and insight. The fix. Mandatory cognitive rest. Dedicate unscheduled time to activities that force your brain into a state of low information input. The clarity hour. Use this time not just for work, but for meditation, silent walking, or journaling without digital devices. This is where your best third-order consequences are often discovered. Digital Sabbath. Commit to at least 1 full day or half day per week entirely disconnected from screens. This restores attention capacity, which is the ultimate non-renewable resource. Your final action step is to immediately unsubscribe from 3 non-essential news or media sources that you consume purely out of habit or fear of missing out, thus building your psychological moat. You have mastered the psychological moat and secured internal clarity. The final frontier of advanced wealth management is the ability to view global instability not merely as risk, but as a source of highly asymmetrical opportunity. This episode is about graduating from hedging geopolitical risk to strategically capitalizing on it. Pillar 1. The panic premium capture. Geopolitical events, conflicts, trade wars, elections often cause irrational short-term panic selling, creating a panic premium. Assets temporarily trade far below their intrinsic value. The fix. The disciplined deployment trigger. Pre-allocate cash. Maintain a dedicated, slightly higher than usual cash bridge, specifically for deploying during moments of acute global panic. The intrinsic value test. When a geopolitical shock hits, for example, a regional crisis causes a 10% market drop. Immediately filter the affected assets through your value doctrine. Are high-quality companies with strong moats suddenly trading at a 30% discount to their calculated intrinsic value? If yes, deploy the panic premium cash. Be greedy when others are fearful. Pillar 2. The regulatory arbitrage. Changes in global tax laws, energy policies, or technology regulations create massive winners and losers. The architect profits by anticipating the flow of capital driven by these regulatory shifts. The fix. The incentive follows policy mandate. Identify subsidies. When a major government commits to a specific goal, for example, energy transition, chip manufacturing, they provide massive tax breaks or subsidies. Invest in the physical infrastructure and companies directly benefiting from those guaranteed government incentives. A subsidized, asymmetric bet. Identify constraints. Conversely, divest from assets facing new, punitive regulations. For example, carbon taxes, export controls before the market fully prices in the damage to future cash flows. Pillar 3. The global talent acquisition. Global crises often displace highly skilled human capital, creating an asymmetric opportunity to acquire top talent cheaply. The fix. The talent migration protocol. Recruitment focus. When a specific region experiences political or economic upheaval, strategically focus your hiring efforts there. You can often recruit world-class talent for your leveraged asset at lower initial cost. Enhancing your global soft leverage jurisdictional agility. Use your established foreign trusts and business structures. Your final action step is to define one geopolitical event, for example, a looming election, a trade policy debate that could create a market shock in the next 12 months, and pre-commit the dollar amount you would deploy from your cash reserves if that event causes a 15% drop in your target asset class. The architect doesn't fear global chaos. They prepare to capitalize on the predictable irrationality it creates. You have mastered the entire curriculum. From the blueprint to geopolitical strategy, your system is robust. This ultimate, final episode synthesizes the core lesson of the entire series. Wealth is not a destination. It is a process of perpetual optimization. The greatest architects do not stop building when the structure is finished. They shift to mastering its maintenance and evolution. Pillar 1. The rate of change. Audit the speed of decay obsolescence. Entropy is accelerating in both technology and skill. You must measure and counter this decay rate. The fix. The weekly delta check. Data. Dedicate your clarity hour not just to what you did, but to the delta derita, the week's most critical change. Skill delta. What new, high-leverage skill related to your 1% upgrade skill did you acquire this week? Countering obsolescence. System. Delta. What single piece of friction did you permanently remove or automate from your system? Countering entropy. Complexity. Trap. Capital delta. How much closer is your freedom ratio net worth annual expenses to its target this week? Countering distraction. If you don't track the rate of change, you cannot manage the long-term trajectory. Pillar 2. The two-way accountability protocol. Accountability is the engine of sustained discipline. As the architect, you need it from your team, but your team also needs it from you. The fix. The integrity clock and feedback loop. Upward accountability. Schedule regular. Formal reviews where your personal board and key employees are mandated to provide brutally honest feedback on your leadership. Decision-making and adherence to your own principles. You must actively pay to hear the truth. The integrity clock. Review the most recent occasions where you attempted to break your own value doctrine, for example, chasing an easy but unethical deal. Reinforce the integrity filter. Pillar 3. The enduring legacy of process. Your ultimate legacy is not the amount of money in the dynasty trust, but the operational excellence and mindset that the next generation inherits. The fix. The playbook. As gospel. Ensure the architect's playbook is not a static historical document, but a living guide. Update, mandate. The rules for capital allocation, asymmetric investing, episode, Dizis and crisis protocol must be reviewed, tested, and updated annually by the family and professional advisors. This forces the next generation to engage with the process of wealth, not just the product. The final word. The series has provided the ultimate map and the perfect tools. Your final, perpetual mission is to never stop optimizing. We have reached the absolute endpoint of the curriculum. This final synthesis extracts the 7 most critical, non-negotiable laws, the very creed that separate the temporary rich from the perpetual wealth architect. These laws are a blueprint for thinking, acting, and living with financial mastery. The law of asymmetric action risk. The principle, never seek proportional risk. Only engage in investments or efforts where the potential downside is limited and none, while the upside is uncapped and exponential. The action. Focus 80% of your time on strengthening your moat defense and the remaining 20% on asymmetric moonshots offense. Your job is to find opportunities where you are, right only 2 out of 10 times. But those 2 wins pay for the 8 losses 10 times over. 2. The law of compulsory investment discipline. The principle. Wealth is built not on earning, but on what you automatically save and invest. Your future self must be paid first and without fail. The action. Automate the transfer of your investment fuel and R&D lockbox. The instant income hits your account. Consistency, the discipline paradox, in this ritual outweighs any market timing skill. 3. The law of soft leverage growth. The principle. Your greatest financial multipliers are non-monetary: time, authority, and knowledge. Money should only be used to acquire more of these 3 assets. The action. Invest relentlessly in your 1% upgrade skill through the 5-hour rule. Use that skill to build systems, recruit global talent, and create nonlinear value for your leveraged asset. Maximizing your output per hour, OPH4. The law of the inner game mindset. The principle. Your psychology is the single weakest link in your system. Fear, greed, and the hedonic treadmill are more dangerous than any market crash. The action. Master the Stoic protocol. Focus solely on what you can control, your system and your effort, and ignore the uncontrollable noise. Separate your self-worth from your net worth. The law of defensive architecture defense. The principle. The primary goal of wealth management is preservation, not just accumulation. Build the fortress before seeking battles. The action. Maintain a robust, non-negotiable financial firewall of liquid cash. Diversify your risks across geographies, currencies, and asset classes. Plan for the crisis before it happens. The law of value doctrine strategy. The principle. Never confuse price with intrinsic value. Financial stability comes from buying high-quality assets at a discount and holding them for the long term. The action. Only invest in assets with a clear, durable moat. When allocating capital, always prioritize purchasing time and experience, high personal value over disposable consumer goods, low personal value. 7. The law of perpetual legacy purpose. The principle. True wealth is not measured by the accumulation of capital, but by the meaningful impact and transfer of wisdom across generations. The action. Define and pursue your legacy metric. Use your wealth to fund scaled solutions, strategic philanthropy, and actively mentor the next generation, transferring the process of wealth creation, not just the money. The system is complete. The principles have been laid bare. Your final mission, architect, is to execute the creed with unwavering discipline and courage. The architecture is complete. Now, begin the work. The Wealth Architect Epilogue. The Billionaire Blueprint. Real-world application. The ultimate test of any financial system is its application in the real world. This final chapter shifts from theory to reality, examining how the world's most successful wealth architects, the billionaires, applied the very principles you've mastered. Case Study 1. Jeff Bezos. The law of asymmetric action. Amazon. The principle applied. Asymmetric risk and value doctrine. The story. In the late 1990s, the consensus was that e-commerce was too risky. Bezos launched Amazon, not by focusing on short-term profit, but by focusing on long-term market dominance. He constantly reinvested profits into infrastructure warehouses, servers, logistics to achieve an unassailable cost and efficiency advantage. The architect's insight. Bezos practiced the law of asymmetric action. He knew the maximum loss was the failure of the startup limited downside, but the maximum gain was owning the entire market for retail unlimited upside. He invested based on intrinsic, long-term customer value, ignoring the initial high-cost, low stock price and lack of short-term profit. He built a system, a massive logistics network that competitors simply could not replicate. Case Study 2. Warren Buffett and Charlie Munger. The law of defensive architecture. The principle applied. Defensive architecture and value doctrine. The story. The core of Berkshire Hathaway's success is not aggressive stock trading, but defensive financial structure. Buffett built his fortress using permanent capital from insurance float money he holds for free until claims are paid. This free capital is the ultimate financial firewall, and allowed him to buy assets cheaply during every major panic, the panic premium capture. The architect's insight. They mastered the law of defensive architecture. They were ruthlessly patient and only invested when assets were trading far below their calculated intrinsic value margin of safety. Their system ensured they always had cash when everyone else was desperate, the ultimate expression of asymmetric patience. Case study 3. Elon Musk. The law of soft leverage, the principle applied. Soft leverage and innovation portfolio. The story. Musk succeeded by applying high-level knowledge and first principles thinking to seemingly unrelated. Established industries, aerospace, automotive, energy. His expertise in physics and engineering became the soft leverage that allowed him to see solutions others missed. He attracted top talent by selling a compelling, massive vision legacy metric. The architect's insight. He maximized the law of soft leverage. His greatest investment was in knowledge transfer and talent acquisition. He used his vision, authority, legacy to acquire human capital and government support, leveraging those non-monetary assets to build the innovation portfolio companies that created entirely new markets. Epilogue. The final summary. Every great fortune is built on a simple foundation, perfectly executed. Find your asymmetric play. Fund it with compulsory discipline. Defend it with non-negotiable systems. Guard your mind against the market's noise. The architect's journey is not about the amount of money earned, but the mastery of the process of creation. The series is now truly complete. Go forth and build your masterpiece. Thank you for joining me on this journey. If this series has provided you with value, make sure you subscribe and hit that notification bell because we are just getting started.